Hi, I'm Jack Leslie, Portfolio Manager at Miller Howard Investments. Lately, our clients have been asking us what we think about the recent increase in stock market volatility. Professional investors often measure volatility using the Chicago Board of Options Exchanges Volatility Index, or the VIX for short. If you look at a recent chart of the VIX, you can see that after about a year and a half of relative stability, the index spiked up in February. The blue line shows the index level at the end of the second quarter. Even though volatility is now down from that spike, it is still above where it had been before. This increased volatility might seem unsettling and perhaps even ominous, but if you take a longer-term view and look at the average of this volatility measure since its inception, shown here by the dark red line, you see a different picture. Now you can see that even though volatility is higher than it had been most recently, it is still below its long-term average. In fact, if we look at a chart since the VIX's inception, we can see that volatility has been pretty tame over the last few years. When looked at in this longer context, we can see that this recent spike only seems more unsettling because the market volatility had been much lower than average lately. Even the timing of the recent spike is far from exceptional. Volatility has spiked this high at least 9 times since the start of the index over 28 years ago. Sometimes much higher, and often it has remained higher for longer. This means that on average, we see one of these spikes every 3 or so years, and coincidentally, the previous one was just about 3 years ago. The stock market doesn't follow a timetable, of course, but the timing on the most recent spike is pretty unremarkable. Now, if knowing that recent volatility is below average and well within the range of what's to be expected still doesn't make you feel any better, perhaps you could find a stock market strategy that will let you sleep better at night. Let's look at the components of volatility. Professor Roger Ibbotson has researched U.S. asset price movements back to 1926. Using his data, we can see that since 1990, the Ibbotson Large Company Stocks Index has annually returned somewhere around plus or minus 37%. That's a pretty wide range. But his data also lets us break down these total returns into their 2 components, price return and income. Here we can see that stock prices are what drive this volatility. Looking at his price-only return data, we can see that large company stock prices have swung anywhere between up 34% and down 38% during this time period. That's a lot of price variance. In fact, price volatility accounts for almost all of the stock market's volatility. It's prices driven by investors' fear and greed that drive the ups and downs of these large company stock returns. When we look at just the income component of total return, shown here on the same scale as the last 2 charts, we see that the income returns aren't volatile. Income or dividend yields have added between 1.1% and 3.8% to shareholder wealth every year, without the peaks and valleys seen in stock prices. Another feature of the income portion of total returns is that it is always positive. Sometimes a bit more, sometimes a bit less, but always positive, always adding to the investor's wealth, always pushing total returns higher. If stock market investors can focus their investment strategy more on more stable dividend income rather than on more volatile price return, they should expect less volatility in their portfolio. For some investors, that could mean a better night's sleep while still staying fully invested in the stock market.
For more information about Miller Howard and the investment solutions that we provide, please visit our website at www.mhinvest.com. You can also follow us on Twitter at @MH_investment. Finally, you'll find much of our value-add content on LinkedIn by following Miller/Howard Investments. Thank you for watching and for your interest in Miller Howard Investments.